We're just about halfway through the year. Let's take a look at the consumer health checkup as we prepare for Q2 earnings season. Okay, friends, let's do a consumer checkup. Here's what you need to know. First up, US consumers are showing signs of stress. Now, this week we got retail sales, and it was an interesting report, not only because it was a miss on the monthly retail sales, but we also revised lower the previous month's data. And I thought the best way to look at this, because any 1 month's data point can be very noisy and it gets revised a whole bunch. So I thought a nice way of looking at retail sales would be, let's look at real retail and food service sales. So what this does, this removes the impact of inflation, and we're going to look at it over time. So this is actually 1994 to where we are today. And what I think is very interesting about looking at retail sales in this way, it removes a lot of the noise and it gives you some clarity as to how to use this data point. If you look here, very clearly what you can see economic expansions that's rising or increasing in retail sales. And then you can also see periods of time where we get some trouble and cause recession. And typically that's usually signified by flatlining retail sales. So here's 1994 to 2000. That was obviously a very strong expansion, retail sales growing the entire time. This is real retail sales, so including the effects of inflation. Then we enter into this flat period through the recession. Then post-recession, we started growing once again. And then as an early signifier of the 2007 global financial crisis, we had this flat topping in retail sales. Then from our bottom, the fantastic run we had all the way through, a short-term ridiculous drop in terms of COVID, very strong bounce back post-COVID off of stimulus and everything else. And then since roughly around early 2021-ish, we've had this flat line to slightly declining retail sales. So what does this tell us, taking the totality of data into account here? Consumer stressed, right? Something that we know if we look at companies, if we look at the economy, one of the reasons why the stock market is so narrow these days, a lot of businesses really aren't doing well. And one of the reasons why is the growth engine of the US economy, which is consumer spending, has really been constrained since early 2021. And we're starting to see that in the data these days. I think another interesting way to look at consumer health or consumer behavior is, what about if we just look at the delinquency rate, right? Typically, people pay their bills. And so if the delinquency rate on something like credit cards, i.e. the percentage of credit cards where people aren't paying their bills or are late paying their bills, it's typically a good early sign of consumer stress. Here's 1991 forward, and what you notice is you typically have an increase in delinquencies, certainly here in the global financial crisis. Typically, people stop paying their bills or start to become delinquent or late paying their bills when economic conditions are pretty weak, i.e. recession or cooling off. And what you notice if you look at the modern period credit card delinquency rates, we have recovered all the way to the pre-pandemic trend, and now we're kind of moving into new territory. Certainly not new territory if we look forward, from the early 90s to now, but certainly new territory, at least post-global financial crisis. Now, some of this is sort of like returning to normalcy. Post-pandemic, we had such unfathomably low delinquency rates because everybody was flush with money. And typically when you're flush with money, you pay your bills. And so we naturally have some bounce back here. What I'm interested in is to see how high this delinquency rate climbs. How much further do we go from here? That's going to tell me a little bit more about the health of the consumer. One final thing that I think is interesting to look at as we do this consumer checkup at the mid part of the year, let's look at banks. Banks tightening lending standards across loan categories, weighted by outstanding loan balances by category. Now, what does this mean? This just means how easy or hard is it to get a loan of any sort from a bank. And what you notice is this is how banks respond to consumer stress. One aspect of consumer stress is, can you pay your bills? The other aspect of consumer stress is, can I get a loan? Because so much in the US economy, it relies upon lending, loan growth, right? Autos, furniture, homes, right? All of these things, typically, there's a loan that comes along with these purchases. And so if banks are tightening lending standards, that's going to decrease the amount of loans that can be created, irrespective of consumers' desire to spend. So what we notice here is This is the zero line. And so basically the way you read this is every time it's negative, that's where banks are loosening standards. And every time it goes up, that's when banks are tightening standards. One of the things that you notice if we look at 1991 to current, typically tightening lending standards, cutting off that access or availability of credit is another sign of recession or recessionary periods. Here you can see the global financial crisis, things were very strong. Here's the COVID spike. Here's the deluge of free money. This was, banks were giving a loan to anyone with a pulse in 2021. And then since then, we've had a very strong spike in banks tightening lending standards. And we still have that. Until we punch below the zero line, we're not going to get into a symptom where banks are loosening standards. But essentially what we see here is something very similar, right? Banks are responding to these delinquency rates. Banks are responding to the consumer getting tapped out by increasing their credit quality, tightening standards. You need higher credit scores. You need to bring more to the deal. You're going to be borrowing less. That's what we mean when we say banks are tightening lending standards. It's harder to get a loan. The loans you do get are typically smaller, right? So what does this all mean as we do the consumer checkup? Well, retail sales reported earlier this week was a miss, and they've flatlined since 2021, right? So there's some consumer weakness on the spending side. Delinquencies are starting to rise on many different types of consumer loans. We looked at credit cards, but you could look at autos and a couple others. The only big asterisk here where we're not seeing delinquencies really is in mortgages. Typically, if you've got a house, you've got access to credit. But for everything else, that's where we see this trend. Banks are responding to this by tightening lending standards, right? So these are all the charts that we looked at. These are all the conditions. What does it all mean? Well, we're going to see what this means for companies as we approach the Q2 2024 earnings season, which is, right around the corner. But what this tells me is I think these trends are pretty durable. I think it's going to be a pretty challenging time in Q2 earnings. I'm not talking about the Mag 7 here. Remember, those are unregulated monopolies. They sort of float above the business cycle. But for all the other businesses, for the other several thousand stocks in the market, I think what we're going to see is we're going to see some of this economic weakness playing out. So there you go. That's the news review. I'll see you this weekend for a markets review. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.